This bullish 2007 through present day 2020 silver spot price chart was shared yesterday by Octavio Costa of Crescott Capital. We spoke with Tavi about 1 year ago, specifically about his bullishness for gold 2020s. Denominated in either openly quasi-pegged fiat Chinese yuan or fiat Federal Reserve notes since we spoke with him in late May 2019, his bullish gold bet is up around 37% since then in either fiat currency. But back to his bullish silver tweet from yesterday. Tavi states, explosive tailwind, best analog for silver, late 2008, 1.3 trillion of monetary stimulus in 70 days, and silver went parabolic for the next 2 years. Today, the Fed already doubled that. Gold-silver ratio near record highs. Largest disconnect in physical and futures in a decade. Here's a quick unbiased update on his final 10-year price divergence point. This chart illustrates how the silver bullion market's most high-volume purchased silver product, the U.S. Mint's 1-ounce American Silver Eagle coin, is trading in terms of premiums over spot. There's been a slight drop since last month's over 70% above spot price premium spikes, down to around 44% of late. So the most often bought silver bullion products are already trading in the middle and lower 20s per troy ounce, around where that second yellow arrow is tipped at. How much longer will it be before silver spot and COMEX futures catch up to that fact? Well, judging by today, perhaps silver's breaking out and it won't be too long. Fueled by recent fiat currency creation initiatives, we strongly suggest that when silver spot prices finally again do go on their next major run higher, the old $50 an ounce level is not going to remain resistance, but currency debasement support for a likely run towards 3 figures per troy ounce. We'll leave a link in the comments below on an already inflation-sown reasonings for that statement. Hello, this is James Anderson of SD Bullion, and we're about to cover some major reasons why some commercial banks who trade in precious metals derivatives have recently been getting their heads handed to them by gold. First, an update on unprecedented unemployment filings in the USA. Another 3 million have been added to this swelling total of 36.5 million who've lost their jobs. Reportedly, 40% of those making less than $40,000 salaries have lost their employment over this foul crisis. Remember that the Federal Reserve blog glibly has this unemployment figure clearing 50 million by the end of next month, June 2020. The Federal Reserve's balance sheet is on the cusp of clearing 7 trillion, up now almost 3 trillion since we began giving you these numbers in middle November 2019 here at SD Bullion. How much longer until the next 3 trillion get dumped onto this balance sheet? This here is the full fiat Federal Reserve notes price in gold over 50 years throughout this full fiat currency era. Here is the same chart in this 21st century bullion bull market context. Recent COMEX gold-stopped contract deliveries are now near 14-year highs, and weak-handed interest has been carved off by nearly 300,000 contracts since the viral spot price shakeout a few months back. It appears that the remaining players in this gold futures market should be stronger, more solvent hands moving forward. Let's have a look at recent COMEX silver delivery demand. The fourth section on this chart shows that we are again at 14-year highs in terms of silver futures contracts stopped for physical delivery. All this silver bullishness is occurring now that some 100,000 silver futures contracts have been wiped away from open interest. The weak hands are out, and possibly too some commercial banks may be going net long in silver and gold ahead. Now let's zoom into the last 2 years of gold price for some recent reminders and clues as to what have been happening in the precious metals arena. Just less than 2 months ago, we had major disruptions in the gold market like we've never seen before. The gold futures versus gold spot price divergence gave many of the largest gold traders losses so large that one of the longest running commercial banks has now publicly declared it's finally now quitting, on its way out of the business entirely after hundreds of years trading precious metals. We covered the Scotiabank Precious Metals Trading Desk closure story a few weeks ago, and their latest losses trading precious metals were likely the final straw for their parent company, Bank of Nova Scotia. It probably didn't help either that they, too, were under U.S. Department of Justice probings. It was recently reported that they handed over 800,000 documents surrounding the ongoing criminal investigation of JP Morgan's precious metals desk and commercial bank at large. News from this week: another massive gold derivative commercial bank suffered huge losses during the late March gold spot price fall and fast rebound. Apparently, HSBC lost anywhere from 200 to 300 million intraday in late March 2020 as some exchange for physical trades went wrong given the large price discrepancy between London and New York. Or perhaps they were just caught short as the price of gold rebounded quickly from $14.75 back to $16.50 in a matter of days. Both of these banks, HSBC and Scotiabank, are probably still sitting on uncovered precious metals derivative losses. And meanwhile, the price of gold and silver looks set to make major runs as early as next week. HSBC remains one of the world's largest, most systematically important banks, according to the Bank of International Settlements, FSB. In other words, HSBC's potential failure threatens the global financial system about as much as a Citi or JP Morgan failure. A one-day $200 to $300 million intraday loss sounds large, but these guys have paid well more in the past for doing business. Here's a quick reminder from the year 2013 by an actual muckraking financial journalist, Matt Taibbi.
You're working on a story right now to come out in a couple of weeks on the HSBC settlement. Tell me about that, why it interests you.
Well, the HSBC settlement was a really shocking kind of new low in the history of the too big to fail issue. HSBC was a serial offender on the money laundering score. They had been twice given formal cease and desist orders by the government, one dating back as far as 2003, another one in 2010, for inadequately policing the accounts in their system. They laundered over $800 million for cartels in Colombia. Drug cartels in Colombia and Mexico. They laundered money for terrorist-connected banks in the Middle East, Russian gangsters. Literally, I talked to one prosecutor, it's like they broke basically every law in the book and they did business with every kind of criminal you can possibly imagine. And they got a complete and total walk. I mean, they had to pay a fine.
$1.9 billion, a lot of money.
It's a lot of money, but it's 5 weeks of revenue for the bank, to put that in perspective, and no individual had to suffer any consequences at all. There were no criminal charges, no individual fines, which was incredible.
If we look at present-day financial charts in the U.S. bond market right now, it appears that regardless of what the private Federal Reserve may say, negative interest rates, or NIRP, may be coming soon to the USA. The bottom of this Guggenheim forecast for U.S. 10-year bonds shows that bonds could yield as low as negative 2% by the start of 2022. Now that may sound extreme and ridiculous on its face, but how ridiculous would we have looked at ourselves saying what we know now has come to pass only 3 or so months ago? What's that going to be like 15 months from now? We are currently dwarfing the 2008 financial crisis already. We've not even begun to start the real insolvency and bankruptcy phase yet. The financial powers that be, they can paper over short-term financial market disruptions, but they cannot bail out large-scale insolvencies nor inefficient business models that can no longer remain solvent in this post-fire landscape. Once we near the peak of the insolvency phase, this chart forecast says that big capital may be fine with guaranteed losses and at the very least the return of some capital versus other failing options and the potential complete outright loss of their capital. Chart also says, next 2 years of time, the tumultuous financial trends that we're on should continue. Keep your eyes on the bond and bullion markets to come. And thanks for watching. All the best to you and yours out there. If you enjoyed this content, be sure to give our video a thumbs up and perhaps share it with those you love. To keep getting bullion-related news and industry insights, be sure to subscribe to our channel. Finally, hit that alert button so you know when we publish fresh content. Give us your thoughts in the comments below. Let us know what you think and which topics you want to hear more about.